G'day, Sean Murphy from My Mortgage Freedom. We're coming to you with an opportunity to join us for a webinar so you can do it from your own home. We're going to take you through a few things that have been changing in the lending and banking landscape. This will be targeted for self-employed people. So the self-employed market's always been a little bit different to those that just have a normal full-time job and earn a stable wage. Self-employed products are different, but they've evolved a lot and they're obviously changing all the time. They're a lot better these days than they were a couple of years ago. So we want to cover a few things that we think may be of interest to you, and you can research whether or not it's an opportunity you want to take up. The first one, buying a commercial property in your self-managed super fund. So this is buying your own business premises or an investment property, but generally for self-employed people, they buy their own factory or office or shop or retail space, and they buy it in their super fund, and then they use their business to rent it off themselves. So rather than paying a landlord rental income, you're paying your own self-managed super fund. And of course, the tax benefits and the capital growth at the end of the day is what you're really after. The second one is business debt. So business debt is a big one at the moment. Every bank approaches this in a completely different way. Some banks will look at your financials, and if you've got debt on the balance sheet, even knowing your company's already paid for that debt, they're going to go and see that debt and expense it in your personal name as well. This makes it pretty hard for serviceability, but there's a whole bunch of lenders out there that don't do that. They'll just ignore any debt on the balance sheet and they'll let you go and take out a home loan or a commercial loan or something like that, and they'll basically assume that it's your business's responsibility to pay that liability. We'll basically cover off on how you can prepare if you know you're going to be lending or borrowing money from a bank for a house or investment property or a commercial property in the next 3 months, 6 months, 12 months. We'll show you how to prepare, and then we'll also show you how to access our team so that you can have a one-on-one conversation with them to make sure that you are in the best position for when that time comes. The third thing is ATO debt. As we know, being in business, making any money at all, the ATO always wants their clip. They have become a lot more aggressive these days. They've become more aggressive in their collections in comparison to 2020, 2021, even 2022. A lot of people were using the ATO like a bank almost. They're not that charitable anymore. So what we're going to do is we're going to show you how to, navigate what works and what doesn't when it comes to balancing, ATO debt with lending. So if you know you need to go and borrow money to buy a house or an investment property or something in the next few months, again, we need to manage that debt, because some banks, as soon as they see that on the balance sheet, they're going to kill that deal on the spot. And then we need to drop down a tier and start looking at second tier lenders, which we want to try and avoid. And there are ways to do it. We'll be going through that in depth, and we'll be looking at real case scenarios, workshopping different deals that may relate to you, and as we know, cash flow has become probably the tightest it's been in a very long time. I'd go as far as saying up to 15 years. So we understand that, but the ATO is not being helpful at all with how aggressive they've become in collecting that debt. So that's going to be a really interesting one to break down and unwrap for you. And the other one that applies to everyone, but any homeowner, any investment property owner, is the interest rates falling. So the interest rates have obviously started to enter an easing cycle. We expect this to continue throughout 2025 and well into 2026. We don't know how aggressive it's going to be yet, depending on macroeconomic conditions and what's happening around the world, which is all pretty crazy at the moment. But a lot of people don't actually know what actually happens when the rates drop. Does the bank just pass on the rate cut a couple of weeks later and then your repayments drop the month later? Well, that actually depends from bank to bank. Some banks will automatically reduce your repayments. Other banks like NAB will say, no, we're helping you out. We're going to leave your repayment at that higher level, and we won't pass on the payment reduction, but we will pass on the rate reduction. This is basically to enable you to pay off your home loan faster. This is true, but not everyone really wants to keep their repayments at the higher level in a cost of living crisis. So it's really individual for what you want and what you need from your bank. We'll take you through that step by step, and we'll also show you how to make sure that when the banks are passing on these rate cuts, that you are maintaining your competitive rate and being in line with the lowest rates that bank is offering new customers. Because as we know, they're always dangling the carrot to try and get new customers in the door on the best possible rates. They very, very regularly forget about their backbook customers, which is you, the loyal existing customer. So if you're going to allow the bank to leave your repayments at whatever repayment it was at the interest rate cycle high, I'm going to give you an example of what that would mean. Let's say you did that for 4 rate cuts. They originally priced 4 rate cuts for 2025. I think that we will get there. If not, we'll make it to 3. If you were to leave your repayment on what it was at the beginning of 2025, and you had a $550,000 home loan, this is the scenario. Your repayment of $3,386 a month, if you just leave it there and allow the rate cuts to come into effect, you're going to save yourself $131,000 over the life of the loan, and you'll knock 6 years and 3 months off the home loan term. That's by doing nothing. So that is probably the only silver lining of a high interest rate cycle, is that if you can somehow get comfortable with those repayments and you become, I guess, capable of managing that budget and managing it around that repayment, then leave the repayments there, and we'll take you through those strategies as well, because the more you put in, the faster your home loan gets repaid, and I guess the faster you're out of debt and you can do other things with your money. So come along, it'll be quick. I reckon it'll probably go for about half an hour, and then after we've finished going through our content, we're going to put it out to you guys to ask any questions you've got. I think you'll learn a lot, and I think given that how much has changed in the last 12 to 24 months, especially with banking for self-employed people, you'll be able to sort of equip yourself with what you need to go through to 2026 and 2027, and we'll keep offering this stuff to keep you up to date and abreast with what's happening in the industry. So I hope to see you there.